The following is a presentation of TFNN. Live at TFNN, the Small Cap Roundup, with your host, Kate Stalter. Now, Kate Stalter.
Oh, welcome to the Thursday edition of the Small Cap Roundup. Looks like we're back today to some of this market indecision again, obviously trading to the downsides, no indecision in that regard, but I'm just kind of watching. It's almost just minute to minute. You're seeing that the major indexes will decline again sharply, then try to rally back, then decline again. So we're seeing bulls and bears fighting it out. But right now, as of this point in the session, bears appear to be winning. We're seeing some heavier trading volume today. And, we are less than a week into this fledgling market uptrend. And this is still when you're at that very vulnerable point for new market rallies, that they can literally be taken down very, very quickly. And of course, for traders, that means this is the point in time when we need to be quite nimble, because if you wait too long, if we are indecisive and we wait too long before getting into some of these stocks, the ones that I like, of course, are the ones that are showing good fundamentals, some decent day-to-day volume. In other words, even though I'm looking at the small cap and lower price stocks, I don't like the ones with the thinner trade. I typically try to avoid those in most cases. And I want to see some good chart support, and there are a few different ways I go about that. There are some stocks that you really cannot wait until they clear a new high, as some of the traditional popular growth investing methods would suggest, is that you're looking for some kind of new high. A lot of them lately, if you watch their charts historically, at least since 2007, 2008, that hasn't worked with a lot of them. As soon as they clear a new high, that's it. They turn tail, and anybody who bought at the new high will see losses. Now, that's not always the case. There are some stocks, if you look at them, that is how they still tend to work. But you have to look at each individual stock and say, okay, is this one that perhaps looking at some indicators like support at perhaps a 5-day moving average or a 10-day moving average? Is this the kind of stock that's where you want to get in on this, or a moving average crossover, where a shorter term line, like perhaps the 20-day crosses above the 10-day line, or maybe you have the 10-day line crossing, I'm sorry, I think I said that the wrong way. If you have the 10-day line crossing above the 20, or the 5 crossing above the 10, then in cases like that is where you want to come in there and perhaps make a buy into some of these stocks. Now, the problem that occurred recently, and you do see this quite a bit, is that those bullish moving average crossovers where the shorter term line crossed above the longer term line, some of those occurred while the market itself was still in a downdraft. So it does mean you have to act quickly then when the market does go into a new upturn. But of course, the flip side of that is you have to be prepared to cut losses quickly. And I mentioned the other day, I was talking to a friend of mine, outstanding trader, Steve Burns, and one of the things that he made a point of in an interview we did on Money Show, and if you haven't checked that out, I recommend you do go over to Money Show and take a look, moneyshow.com. It ran a few days ago. It ran on Tuesday, I believe. But one of the points that he made is he said, it's not uncommon for traders to have 10 losses in a row. You just got to keep them small. And I think we all know that feeling, is you can get very, very discouraged. And particularly in a market condition like we're in right now, it's been challenging on both the upside and the downside just because of this rather trendless nature that we've seen. Once a trend does get underway, either to the upside or the downside, there seems to be some news development or just market sentiment. Who knows? Who knows what it is? As my friend Jim Rohrbach says, and I agree with him, and Michael Covell says this as well, you see a lot of times the media trying to attribute a market move to some particular news item. Now, I think in some cases you can see where the sentiment has been affected. We had some disappointing manufacturing data from China, and I was looking at some of the Asian indices early this morning and happened to notice that they were trading lower on some of that disappointing Chinese manufacturing data. You know, of course, everybody talks about a Chinese hard landing, but according to the numbers they tell us anyway, and really, who knows what Beijing is doing to massage some of these numbers. But the GDP growth they have over there, even as it's slowing, is GDP growth we can only dream about here in the U.S. Then we have the Philly Fed econ data showing a slowdown in manufacturing in that region. So there were some sentiment indicators, if not actually hard economic indicators, but they do affect sentiment. And that, I believe, did affect some of the market this morning. Although, as I said, many of the trend followers like to just simply ignore the news and even dismiss it. I'm kind of somewhere in the middle. I would rather go by what the trend is telling me, but sometimes you really can see what's going on in the news and understand why a particular market move or a particular stock move is happening the way it is. Now, I'm just looking over here at my screen. I'm seeing, let me put up a chart here. I have the chart for the IWM in there, which is, of course, the Russell 2000 index. I usually start out the show with that, with the small cap index, but I'm going to put up a chart here for YCS because I understand we have a caller on the line, Frank from Lexington, Massachusetts, that wants to take a look at the YCS. Yeah, and I do know this one well. That's right. It's looking pretty good today, isn't it, Frank?
Yeah, it is. And the inverse, of course, is FXE.
Mm-hmm.
And
that's put that one up.
I'm sorry, FXY.
Mm-hmm.
That's the yen trust. And so I sort of try to use both. And I've been waiting a long time here for the yen to finally turn around.
Mm-hmm.
And, boy, it looks like the volume is projecting pretty high today for that YSC. And also,
right.
Hi. So I don't know what the small caps over there in Japan, but it's got to be affecting stocks too.
Right. You know, now this is one of these cases, it's along the lines of what I was just talking about, Frank, of looking at the market indicators and the news. And this is one of these cases when I'm looking at these ultra shorts or these inverse ETFs, I am not going to be trying to prognosticate based on news. I am going to be simply a trend follower in these particular cases and setting the stops very tight. I mean, if you can ride this one as it goes higher, that's fantastic. But I do think the problem that people run into is when they try to predict what's going to happen, and then they find themselves in the position of arguing with the market, you know, where they're saying, well, this is what's supposed to happen, or the data are showing that this just can't be. Well, it is. Right, so right. I like this chart right now very much. Are you in this one right now?
Yes, and you know, I think I've got this figured out. So my question is, are there stocks that a falling yen will help to increase in price?
Yeah, again, this gets into the realm of economic prognostication, which I don't do. But I can tell you what the common wisdom is and what I've just seen over time, and I don't trade based on this. Okay. But you do see the typical Japanese exporters, right? The car makers, the electronics makers, but again, some of them have gotten into trouble. They're not really on my screens, I got to be honest with you, because they're just not top performing stocks. So again, I would my method of trading is not to guess based on what I think the economy or what a currency is going to do. It's really based on the charts in these cases. So if you want to go back and look at some of the exporters, the automakers, the electronics companies, I mean, those are the two big categories, right, that the Japanese exporters fall into, and take a look at how they're doing. I just happen to know that, for example, Sony, let's just for fun, let's pull up Sony, SNE, and I know that has been in a world of hurt lately. But yeah, see, it's what happened here. Now, this is interesting. I've got a daily chart of Sony up here. And I know we're drifting away from small cap land here, but it really doesn't matter because I would tend to view the charts in the same way, regardless of the market cap for by and large. So what you've seen here is Sony trending higher as the market trended higher, as the global markets were doing well. And don't forget, this is a NYSE traded ADR, so it's going to be moving in tandem, of course, with the U.S. indexes as well, even though it's a Japanese company, and they do a lot of business in the U.S., of course. And so you're seeing, this is really traded just in tandem with the market in recent sessions. So I think that would be how I would look at this, Frank, is not trying to forecast what's going to happen with the economy or the currency or the exports, but just what is the chart telling me.
Gotcha.
So, yeah. Great call. Thank you so much for calling in. Call again some other time. Great to talk to you.
I will. Bye-bye. All
right. Yeah, that was a very interesting call. That was a great question there. Let's see here. I wanted to say a couple things. I've got about a minute and a half here. I can do a couple announcements. Take a look at the homepage of TFNN.com. We have the Low Price Leaders newsletter, just went out yesterday. We've got a few trades on as of this morning, some new trades on. And I'm just going to repeat what I said a little while ago, that we do have to be pretty cautious in this environment. I'm not going to attempt to do any kind of longer-term buy and hold in this market. We've just got to see if a trend is confirmed in one way or the other here. I do see the indexes are weakening as I've been on the air here. But then again, as I said before, we've seen these just attempt to reverse direction several times already today, and I think we know from the past year or so, you never know at what point in the session you might have that market miracle. Well, usually it happens later in the day, and I'm being a little bit facetious there. That's what a friend of mine calls that late day rally that we often tend to see. We've got the European close coming up in about 11 minutes or so, and sometimes you see a little move up on that, not always though, or a move down. It depends. So that's coming up. And in the second half hour of the show, I want everybody to stick around. We have one of my favorite guests, my friend Edward Hornstein from Hornstein Capital Management in New York City. And he's just a terrific trader, got a very unique perspective. He doesn't mind staying out of the market if conditions are like this, and he will talk about his reasons for that. So I will be right back after this break. This is the Small Cap Roundup. Give a call, 877-927-6648.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you gain access to each host charts and computer screen as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, Dave White, Larry Pesavento, or Victor Jones, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV yet, then visit TFNN.com today to see what you're missing.
Stock market corrections are the number one reason that a buy and hold investment strategy produces the poorest results, and I have 73 years of data that proves it. Now, the good thing about economic difficult times is that the worst economy can produce the best rewards in the shortest period of time. In fact, during the last 130 years, 61% of that time period has been spent in recession. And if you're one of the 70% of American households relying on their 401ks and IRAs for retirement, you need the single strategy that is bulletproof against the turmoil of our stock markets. Go to the homepage at TFNN.com. Under Breaking News, click on Success is a Numbers Game to receive this must-have free report. This bulletproof strategy may be days away from giving the next signal. Don't neglect your retirement, and don't neglect this signal. If you're even a little bit interested in accumulating wealth, providing a better life for you and your family, then go to TFNN.com to order your free copy of Success is a Numbers Game today. Implement the disciplines contained in this report, and success will be yours for the taking.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now. It's that time of year again, and the Great Panther Silver Summer Silver Giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of TFNN.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver Giveaway the whole month of June at TFNN.com.
This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
All right, we're back with the pre-European close segment of the Small Cap Roundup. I'm kidding a little bit. That's not really something that I tend to follow too much. Just, it is kind of funny that there's a lot made of that in the news these days. So I say that a little bit facetiously. Okay. Let's see. Before the break, I was making a few announcements, kind of like being in church, isn't it? I'm making announcements right now before we get to the actual programming, but I've got an important thing I want to tell you about, very important. And if you can't write this down, it's very easy. TFNN.com, the homepage. You all know it by now, TFNN.com. There is the Tiger Dollar promotion. That is winding down, so you're going to want to check that out very, very soon. And you can get all the information about that. You can use the Tiger Dollars on the Low Price Leaders newsletter, or any of the other just terrific newsletters from all the other great hosts we have here on TFNN.com. So I really encourage you to check out the details of that. And also, as I mentioned, the Low Price Leaders newsletter. We launched it a couple months ago, and we've got some trades on right now. And just, I added a number of names to the watch list as of yesterday. And it was taking a look at those again. I was reviewing them again this morning, and just taking a look at how some of them really do remain in watch mode, particularly with the market the way it is. Some of these, as I noted earlier, you've got some stocks that are near new highs, and I'll give you sort of a little preview of what I'm talking about. You've got Cirrus Logic, which has been a small cap name, and I'm going to put this up here on a weekly chart for you on Tiger TV. That's been a small cap name that has performed well. You see it trending higher. I've got it there for you on a weekly chart. Now, this is the kind of name, I really like the chart action. It was rallying higher while the market was in a downturn, making it a risky buy in my methodology, because a lot of times you will see these stocks that will rally during a downturn, and that's a terrific sign of strength, terrific show of institutional support in a given name. And of course, this one is an Apple supplier. It's been doing better than its customer, hasn't it? And you see that a lot. It often is a precursor to further price gains when the market goes into a rally. But the other thing that can happen is you will even see a pullback in some of these strong names just due to the weakness throughout the general market. So right now, Cirrus Logic is one that, for example, I would be waiting for a pullback in this particular name, and you've got plenty of room there in the medium term, 20-day, for example, 15-day, even if you go as far as the 50-day simple moving average. So I'm just going to keep an eye on this one. I want to see more of a pullback, because I think at this juncture, just noting the historical trends, the way this stock has traded recently, it could be a bit risky at this point. This is a bit of what I was talking about earlier in the show, is that some of these growth stocks, when they do clear new highs, occasionally it's a little bit late, and you just want to be a little more cautious. Okay, I've got something else I wanted to just talk a little bit about. I speak about a gentleman named Michael Covell. He is the trend-following guru out there. He's written some books, and he posted on his blog the other day that he was over in a conference in Geneva, the Opal European Wealth and Family Office Conference. Woohoo, fancy. So he just wrote here at his blog, "It reminded me again of how much work we need to do to spread the logic of basic trend following amongst this group. The 3-day conference was very much focused on issues of feeling, judgments, and nothing short of predictions about asset classes, which countries they should be investing in, and the general direction of the market. It is genuinely frustrating to find that trend following is still confined to and seen as a specialized CTA, commodity traders advisor, seen as a specialized CTA strategy, one of many others." So in any case, he was just making the point, and one that I speak about frequently myself, is that you do hear a lot of the advisors talking about the big picture, making the prognostications. This is a little bit what came up in our discussion with Frank a little while ago, is that just many of these big picture prognostications, I have an advisor friend, Mike Schell, who's terrific, and he talks about, he calls it ego. He just calls it flat out ego. The advisors, the strategists, quote unquote, who will be talking about these big forecasts for the macro picture. So in any case, there's our music ushering us out of here in this segment. We're going to come back. We are going to have Edward Hornstein after the break, so you're going to want to stick around and hear his take on the markets these days. I'll be right back.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations, including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN has just launched our most exciting sale ever. If you purchase any amount of Tiger Dollars before Sunday, June 24th, you'll receive access to 7 live 90-minute webinars hosted by each of our technicians here at TFNN. Not only do you get a 20 to 30% bonus on your purchase as you normally do with Tiger Dollars, but with this one-of-a-kind offer, you get over $1,000 in added value completely free. Each 90-minute live webinar usually sells for $149, and you get all 7 of them absolutely free. Tom O'Brien, Steve Rhodes, Basil Chapman, Larry Pesavento, Ken Shreve, Dave White, and Kate Stalter. You get all 7 classes completely free. Whether you're an experienced trader or you're completely new to the markets, this sale is perfect for all levels of investors. Don't miss out on our best Tiger Dollar sale ever. Visit the front page of TFNN.com today and purchase your Tiger Dollars before June 24th. Don't wait and risk missing out on this one-of-a-kind offer. Act now.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Well, as often happens, we did have a bit of an increase in the market decline at the European close. We've got the euro-dollar trade slipping there, so not so good. The market tends to not like that, but that's okay. We're not going to be guessing about what could happen. We all know that the situation in Europe is not resolved, and markets could rally anyway. We've seen it happen, that when sentiment is just horrible, the markets do rally anyway, so we're not going to be making some big predictions on what we're seeing there. I'm just watching these intraday swings that we've got on the indices. And more exciting than that, we have my friend Edward Hornstein, who is on the line with us, joining us from New York City or thereabouts. And Ed, I got to start out by saying it was so much fun hanging out with you and your posse there. I'm sure that if Nan and Frank are listening to this, I want to give a shout out to them, because you've got some terrific people you work with, some terrific friends and colleagues there, and it was just a real pleasure getting to see all of you at the Dallas Traders Expo a couple weeks ago. So welcome.
Oh, thanks for having me. Likewise, it was good finally meeting you in person after all these years.
I know. Isn't that funny? We all have all those business friends like that we email, we talk to on the phone, but great to meet up with you finally. It was terrific. So tell us what your take is on the market right now. I know one of the interesting things that we got a chance to talk about a couple weeks ago was the fact that you really do have the discipline to avoid making trades in a poor market. And that's something that's not easy for a lot of people, or a trendless market even, shall I say, because a lot of people, traders want to trade, and they feel like they're missing out on some opportunity if they're not jumping in there. I saw a whole debate on one of the financial channels yesterday about remaining in cash, and a lot of people just feel like, oh, that's so unsophisticated. You're really missing out on so much by doing that. Give us your take.
Yeah, well, it all depends on the type of trader you are. The system that I follow, that I talk about, and that a lot of your listeners trade or have a corollary of it, is modeled after, the Canflin William O'Neill approach. And the key really is to stay out of the market when the market is not giving you a fat pitch and is ripe. And the analogy I like to use is, I'm a baseball fan, and one of the greatest hitters ever is considered Ted Williams. And Ted Williams got so good he had such a good eye for the ball that when he didn't swing, umpires would hesitate to call a strike because they knew he would only swing at the fat pitch. And he got so good that, in interviews, he would say that he would get thrown strikes sometimes, but he knew he had dissected he had broken down the plate into 9 different quadrants, and he knew that with each quadrant where the ball was, what his percent was of getting a hit when the ball was thrown there. So as the years get on, as he matured, he would only swing when the ball was thrown to that area where he had the highest probability for success, and when the ball wasn't thrown there, he wouldn't swing, and he would let it go even if it was a strike, because he knew that the probability was that he wasn't going to get a hit if he swung. And I like to use that analogy in the market, where being trend followers, buying breakouts, buying momentum, it's very important to understand that type of system only works in a special type of market. You can have a market like we've had for the past 3-4 weeks, where the market kind of bottomed in late May and it's come up, but for the system that I trade, it's really not a right market right now to be buying breakouts. The big institutional quality leaders are kind of basing, they could be faulty bases. Maybe they come up later, but they're not doing much of anything. Some of the stocks that have broken out, whether it's a Under Armour, UA, a Cerner, CERN, an Equinix, EQIX, SXCI Health, I can name a few others. A lot of these stocks have broken out and then tucked their head right back into the bases and failed the breakouts. So when that's going on, that's the market telling you that it's not a right market for buying breakouts and for being aggressive. And it's very important to stay out of the market, because I know from experience the easiest thing to do in the market is to give back profits and lose money. And if you trade all the time, that's what one is going to do. So you really only need to be in the market a few times a year at most in a good market. And if you can compound your gains and be smart enough to stay out of the way, you can make a lot of money. The problem a lot of traders have, and I've encountered this problem in my career, is it's the fear of missing out. So they're always trying to get in early or buy something because psychologically they want to be in the market. And they psychologically say, oh, as long as I have a stop loss, I'm not going to lose a lot of money. But over the long term, you take 4, 5, 6, 7 stocks that you stop out for a few percent, and that can add up. And not only does it affect your capital, but it can affect your psychology, which is the other thing. You want to keep your psychology intact, and that's why it's so important to stay out of the way except when the market's in a fat pitch, because psychologically you don't want to get hurt and burned, because when the market does turn, if you've been in the market and you've lost money, you're going to hesitate.
These are great points. I completely agree with you. One of the things I was saying earlier in the show was that this, in some ways, is a particularly challenging time because by some measures, we did have a confirmed uptrend on Friday, given some of the action in the NASDAQ, some heavy volume gains in the NASDAQ. And I think the challenge is you don't want to be late if that uptrend does hold. But by the same token, we had an uptrend in late April that failed. The market conditions do remain fragile. So how do you handle a situation like that, Ed?
Oh, that very good question. The two thoughts that come to mind was that it's not always important to get in at the bottom. And the analogy I use is, so last year the general market bottomed out in early October. It came up, we had a good rally, it kind of whittled around, never undercut the lows. And then we had a follow-through day, I think December 20th of last year. So it was about 10 weeks off of the lows that the market had a follow-through day. And even after that, the growth liquid leaders, Apple, Priceline, Coors, Lululemon, and Starbucks, Chipotle, they didn't really start breaking out and get going until about mid-January. So if you think about it, really for the system that we trade, October, November, it was about 12 weeks off the lows and 5 weeks off the follow-through day that big institutional quality liquid leaders really started to kick in. And you didn't really need to get too invested until that point, and there was a lot of money to be made from January to March or April. So the first thing I'll say is that while the general market could be bottoming, it could go through a period where it's transitioning from correction to bull or bear to bull. Or it can just go through a counter-trend rally and we can roll over. So you really don't want to get invested until you see those big quality liquid leader breakouts. And sometimes that can occur off a good bottom, but sometimes it could take a few weeks to occur. And the other thing I'll say is that, it's letting the market prove itself. In the past few days, we've seen a few breakouts. The first thing I'll say is that they've mostly been in defensive areas like medicals or discount dollar stores, which doesn't necessarily bode well for a growth investor. And like I said, a lot of those breakouts have, tucked back in and aren't working, whether it's a EQIX, you have SXCI, you've had a few others like Cerner and Athena Health, and even a few stocks that have broken out and look decent, like an eBay, really haven't made very much progress. So you'll know it's time to get invested when you start buying some breakouts and they start going. And the other thing is you'll know when you have what I call stock envy, which is when you're not in a few stocks and you keep saying to yourself, gosh, I wish I was in that stock, or gosh, I was in that stock. And right now what we're seeing is the opposite. It's, gosh, thank God I didn't buy that breakout because it's failed miserably. And the last thing I'll say is that the real big liquid leaders that will probably continue to lead until we get a bear market, Apple, Priceline, MasterCard, Intuitive Surgical, Amazon, Chipotle. If you look at a lot of these stocks, they've kind of been lagging the past few days. They've trying to come up the right sides of the bases, but none of these stocks have even come close to breaking out. The volume patterns haven't been good. So when you get in a good market environment, if that happens in the next few weeks, you'll probably see a lot of these liquid leaders really take off. But for now, I'm very, very defensive. I've got high levels of cash. I just don't think this is the right market environment at this time for the growth investor. Best case scenario is that the market maybe sits around, pulls back, and we take off in a few days or few weeks. And worst case scenario, this is just a counter trend rally and a larger bear correction, and we roll over. I don't have a crystal ball, but either way, there really isn't much need from the way I trade to be very committed at this point.
Now, one of the things, and you alluded to this a little bit, is just following the trend. It sounds to me that you're not relying on any kind of predictions about what the economy might do, what European or American politicians might do. You're just watching the indexes and the stocks and making your decisions on that basis. Is that correct?
Absolutely. Now, there's many ways to trade in the market. There's plenty of guys out there. In some of the Jack Schwager Market Wizards books, which are great books, there's a few guys in each of the editions that are global macro guys that look at all of that stuff. And there's a few guys that have a lot of success with that. There's some guys that are value guys that have a lot of success with that. The methodology isn't as important as having a methodology and the proper psychology and following your rules. And the way I trade is that, I let the market tell me what to do. As for the general market, I'm a trend follower. I'm just looking at the market for clues. And as for buying stocks, I'm there looking at the fundamentals and technicals. The fundamentals to tell me which are the best growth stocks. The technicals telling me if the institutions are buying. But as for the economy being miserable in Europe and all that stuff, the market's a discounting mechanism. So just like in 2009, the market will generally bottom when all the news is bad. So all the news is bad. There are a lot of issues out there, and it's definitely affecting the market. But at the end of the day, if the market's ready to go up, all that news and noise from the way I trade is really irrelevant.
Right, right. Well, a related question, I think, then, to all of what we've been discussing here today, Ed, is how should traders handle losses? And you've been talking about the psychology. We've got a couple of minutes left, so we'll have to be a little bit brief on this. But what is the psychology to handling losses and not just getting completely devastated?
Well, most people have a tendency when they start losing money to bet bigger, and you can even see it in a casino. If you notice, when people start losing money, the tendency is to bet bigger to try to get it back quicker. And that could be deadly in the market. When people start losing money, they either double down or maybe they get hit and then they go in more aggressively. And that's the way to get into a hole. So what I do is, if I'm not making money or stocks are going against me and I get stopped out, I'll play it smaller for a while, and let the market prove itself. So if I'm making money, I tend to increase my bets. And if I'm losing money or some stocks aren't working, and then I think maybe the market's going to turn, I tend to go in a little bit smaller, so that this way, as you lose money, if you're testing the market again, you're going in smaller and smaller and smaller, if you're going in at all, because it's very, very easy to lose money. And psychologically, if your portfolio gets hit a few percentage points, you want to get back psychologically to that point where it was, and psychologically the ego wants to bet big and get back there, but that can be a disaster. So if someone's losing money or the strategy's not working, back away, go to cash, and when it's time or you're getting a signal to go back in, start small, pyramid up, let the market prove itself. If you can't make money being 10 or 15% invested, I say, why the heck would one want to be 50% invested?
And, for a lot of traders, and I understand this too, there's sometimes even something discouraging about taking a stop loss. Even if you are really limiting your gains, your losses, you still feel like, oh my goodness, I'm just not winning at this. That's another aspect of this, don't you think?
Yeah, and I use baseball as another analogy. If a hitter hits 350 or 400, 35% of the time they get a hit, they're great. If you're a trader and 50% of your trades are winners and you can keep your losses small, you're going to make a lot of money. So you just got to go into it understanding that when you buy a stock, there's maybe a 50-50 chance that you're going to make money on it. And it's a business cost if the stock goes against you. I don't think of it as, oh, I did something wrong, or, it's a blow to my ego. It's, yes, I know, more than half the time I buy a stock, it's going to go down. And after a while, you kind of get used to it, and the stop losses become a little bit more automatic.
And you're absolutely right, because I've had the exact same experience you have of that in strong market uptrends. That is just going to increase the probabilities that you're going to have some winners here. I know there's data out there. Some people say 3/4 of stocks follow the market. I'm sure there are some empirical surveys somewhere that do validate that, or perhaps even show that it's higher in some markets. But really, trying to bet against the market direction can be a loser's game. And we've got about 30 seconds here, Ed, if you wanted to respond to that.
Yeah, okay, that's an excellent point. You're absolutely right. A bull market will lift all tides. I've gone back and looked at my trading career, and I've pretty much only made a substantial amount of money in times when the market's in an uptrend. And when I've tried to go in and be a hero and tried to, fight the tide and buy the one stock holding up, it's usually not worked out well. So, I stick to probability and history and know what the market's trending well. I've got a better chance of making money.
Right, right. Well, there we go. That's the end of this segment, and thank you so much. I always enjoy having you here. We've had got a couple great comments of people appreciating your wisdom there in our Tiger Den chat room. So, Ed, we will talk again soon, and thank you. Great to speak with you again today.
Thanks, Kate.
All right, stick around, everybody. We got one last segment here of today's Small Cap Roundup, 877-927-6648. I'll be right back.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the opening call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his opening call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and very, very strongly support the use of his opening call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the opening call, a $64 value, visit tfnn.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to tfnn.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Rand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
Welcome back. Last segment of today's Small Cap Roundup. Just want to remind you, check out the Low Price Leaders newsletter on the homepage of tfnn.com, as well as the Tiger Dollars promotion that is currently underway but is winding down in the next few days. Do you want to check that out pretty quickly? Don't waste time. Okay, let me put up a ticker here of cores, if I can get this. This is one that Ed was just talking about, and thanks again to our guest Edward Hornstein of Hornstein Capital Management. He just has a great perspective, and I always enjoy speaking with him. And I think the idea of limiting your trading during times of market uncertainty really is a very good lesson. Now, we are taking a look here at Coors. Now, this is a stock. It actually did sport some gains earlier in the day today. Is reversing lower and looks like it's at about 44.83. Actually, no, 41.83 right now, which is a little bit lower than where it closed yesterday. But nonetheless, this one has been attempting a rally here along with the general market, and you will see that. A lot of stocks that do tend to rally along with the market's trend. Now, this is a mid-cap, and the mid-caps can also be very fertile ground for some terrific stocks that do notch some strong price gains in a new market. I think what we're perhaps seeing now is, as there's a little bit of doubt in some circles with some of these market strategists, and that's the title that a lot of these guys have at these investment banks and brokerages, market strategist. Sounds very impressive. And what a lot of them are looking at now is where the consumer is going, and perhaps that could be having a little bit of an impact on some of the retail names. I'm putting up a chart here for Zoomies, Z-U-M-Z. And if you were listening on Tom's show Tuesday afternoon, I was talking about this stock with him. This is a teen-oriented, youth-oriented clothing store, and this is something right now that is pulling back a little bit, and it's off its highs, really acting in sync with the market as you would expect. Now, I'm going to answer a question that I'm getting here. Is Coors a long or a short? I'm going to go back to this right now. Right now, nothing here indicating to me, by my methodology, I wouldn't try shorting this right now. I wouldn't necessarily be long in this one right now either, just based on what it's doing. Let me take a look here at where this is relative. It's above its 5-day exponential moving average at this point, but the fact that it reversed lower today would give me, and we're talking about Coors here, K-O-R-S. So, yeah, not only is it, I'm getting a comment here, I'm reading aloud from the Tiger Den. Not only is it above its 50-day, but it's above its 5-day exponential moving average. I don't like this intraday reversal we have today, though. I would do nothing with this stock at this point. It's still a good performer, not showing signs that it should be shorted. And besides that, the market itself is not really giving indications that this is a time to be shorting either. We are still in an uptrend, even though we have what appears to be a heavy volume sell-off today. One day to the upside or the downside is not going to be enough to reverse a trend. We all know, we've seen this enough in the past few years, we could have huge gains again tomorrow based on something that somebody in Italy says. So you just never know. All righty then. It's been a fun show. I want to thank my guest, Edward Hornstein, once again for joining us. Thank all of you for listening. Great conversation with our caller today. It's been a lot of fun. I will be back here on Tuesday. And don't forget, check out Low Price Leaders and the Tiger Dollar promotion on TFNN.com. Have a great weekend, everybody.